Stop scrolling. You clicked here because you're ready to master the world's biggest, most liquid financial market, Forex. We're talking about the foreign exchange market, where trillions of dollars change hands every single day. In this video Forex course, I'm covering everything, from what a PIP is to successfully placing your first trade. This isn't just dry theory, it's the practical foundation you need to start trading the right way. Let's get started. What is Forex? Let's start with the basics. Forex is just short for foreign exchange. It's simply the market where national currencies are bought and sold. Think of a traveler buying euros at the airport, or a huge company converting yen to US dollars. It's a massive, decentralized market that runs 24 hours a day, 5 days a week. Here's the first core concept. You always trade currency pairs. You're selling one currency to simultaneously buy another. For example, when you buy EU or USD, you're buying the euro and, in that same moment, selling the US dollar. Why bother with Forex? Why do traders choose this market? First, liquidity. It's the biggest market in the world, so it's easy to instantly get in and out of trades. Second, accessibility. You can actually start with a pretty small amount of capital. And third, it's 24/5. The market is always open somewhere, so you can trade around your existing work schedule. Ready to learn the core mechanics? Let's unlock the language of Forex: base, quote, pips, and lots. Every pair has two sides. Look at EUR USD 1.0850. The EUR is the base currency. It's the one unit you're buying or selling. The USD is the quote currency. It tells you the price. In this example, it costs $1.0850 to buy €1. Understanding pips. A PIP, or percentage in point, is just the smallest way a currency pair can move. For most pairs, it's the fourth decimal place. So if EUR USD moves from 1.0850 to 1.0851, that's a 1 pip move. Quick note, pairs involving the Japanese yen, JPY, are the exception. The pip is in the second decimal place. Lots leverage. Next up, lots, which are just the standardized sizes of your trades. A standard lot is 100,000 units, a mini lot is 10,000, and a micro lot is 1,000 units. If you are starting out, you must begin with micro lots. Don't even think about the others yet. Leverage is money your broker lets you borrow to control a much larger position. For instance, 50-1 leverage means your $1 controls $50 of currency. Huge warning. Leverage is a double-edged sword. It supercharges both profits and losses. Use it with extreme caution. Choosing a broker. Your broker is your crucial gateway to the market. Rule number 1. Regulation. You only trade with brokers regulated by major bodies like the FCA, ASIC, NFA, etc. This isn't negotiable. It's how you keep your funds safe. Also, look for low spreads and fast trade execution. Spread swaps explained. The spread is just the small gap between the buy price, ask, and the sell price in bid. That gap is how your broker makes their cut. The smaller the gap, tighter the spread, the better for your wallet. Swaps are the interest you either pay or receive for keeping a trade open overnight. My advice for beginners? Focus on day trading to completely skip those swap fees for now. Your trading platform, MT4, MT5. The platform standard is MetaTrader 4 or 5, MT4, MT5. Let's do a quick tour. You've got the market watch for prices, the navigator for accounts and tools, the chart window to see the price action, and the terminal for your open trades and history. Highly recommend this. Open a free demo account right now. Practice placing trades with virtual money until you feel totally comfortable with the platform. Don't touch real money until you've crushed the demo. Fundamental analysis. The why. Fundamental analysis is all about tracking the economic health of a country, political news, interest rate decisions, and major reports. If a country's economy is strong, its currency is likely to go up. The big events you track are interest rate decisions, the non-farm payroll, NFP, and GDP reports. The economic calendar. You must use an economic calendar to know exactly when that high-impact news is coming out. Critical warning. Trading during these news releases is extremely volatile. As a beginner, it is best to avoid it completely. Technical analysis. The when. Technical analysis is the study of the price action itself using charts. The basic idea is that everything you need to know is already reflected in the price. We use patterns, indicators, and historical data to predict future movements. Let's dive deep into how this works next. Candlestick anatomy. Forget those basic line charts, we use candlesticks. They are awesome because they instantly show you 4 key data points for any time period: the open, high, low, and close price. A bullish candle, green-white, means the price closed higher than it opened. A bearish candle, red-black, means the price closed lower than it opened. The thin lines sticking out, the wicks or shadows, show the full high-low range. Understanding time frames. Your chart is defined by its time frame. A 1-hour 1H chart means one candle equals 1 hour of action. A daily D1 chart means one candle equals 1 full day. Beginners, you should focus on higher time frames, like 4-hour or daily, to ignore all the distracting market noise. Support and resistance, SR. The theory of support and resistance is simple. Support is a price level where buyers step in hard, causing the price to bounce up. Think of it as a floor. Resistance is where sellers step in hard, causing the price to bounce down. Think of it as a ceiling. Practical step. Here's how to draw them. Find where the price has touched the same level at least twice. The more times it touches, the stronger that SR level is. Trend lines. If support and resistance are horizontal, trend lines are their diagonal cousin. An uptrend is clear because you see higher highs and higher lows. A downtrend gives you lower highs and lower lows. You simply draw a line connecting those points and it acts as a dynamic level of SR. The number 1 rule: risk management. Listen up. This is the single most important module of this entire course. Most traders fail because they ignore this part. Risk management is survival in this game. The golden rule is simple. Never risk more than 1% to 2% of your entire trading account on a single trade. If you have a $1,000 account, your absolute maximum loss on any one trade is only $10 to $20. Stop loss, take profit. A stop loss, SL, is an essential, automated order that closes your trade if the price moves against you too much. It caps your losses. You must use a stop loss on every trade. A take profit, TP, is the opposite. It closes your trade automatically when it hits your goal profit level. Next, the risk-reward ratio, RR. Always aim for at least a 1.2 RR. For every $1 you risk, you should be aiming to make $2. This small detail is the secret sauce for long-term profitability. Developing a trade plan. You never click buy or sell without a plan. Here are your 5 steps. 1. Find the trend. 2. Identify key SR levels. 3. Find a confirmation, like a specific candlestick pattern at that SR level. 4. Define your entry, SL, and TP. 5. Calculate your lot size based on your stop loss and your golden 1 to 2% risk rule. The emotional roller coaster. Psychology. Trading is seriously 80% psychology. Your 2 biggest enemies are fear and greed. Fear makes you bail on a great trade too soon. Greed makes you hold on to a losing trade way too long, or risk too much on the next one. You are running a business. Discipline means you follow your plan even right after a loss. Consistency means you repeat your high-probability setups over and over again. Remember, trading is a marathon, not a sprint. The trading journal. You must keep a trading journal. Log every single trade, the entry, the exit, why you took it, how you were feeling, and the result. This is the feedback loop that allows you to review and aggressively improve your strategy. Practice backtesting. Your final assignment today: practice for at least 3 months on your demo account. Get intimately familiar with the platform and your trade plan. Start backtesting. That's just reviewing old charts to see how your strategy would have performed. Final disclaimer. Listen carefully. I have to be straight with you. Trading Forex involves substantial risk. You absolutely can lose money. Please never invest money you can't afford to lose. This course is for education only, not financial advice. Your success depends entirely on your discipline and practice. Ed. Don't rush this stage. Final disclaimer. Listen carefully. I have to be straight with you. Trading Forex involves substantial risk. You absolutely can lose money. Please never invest money you can't afford to lose. This course is for education only, not financial advice. Your success depends entirely on your discipline and practice. Recap final thoughts. Wow, you did it. Give yourself a huge pat on the back. You just crushed a full-hour Forex course. You now have the knowledge foundation, pips, lots, support, resistance, and the most critical topic of all, risk management. If this video helped you, please smash the like button and subscribe for more trading content. Drop a comment below and tell me, what's the number one thing you learned today? You can find links to my recommended brokers and the free demo platforms in the description. See you in the next video, and happy trading.